The Psychology of Money, a Summary. Morgan Housel's The Psychology of Money is a thought-provoking exploration of the intricate relationship between money and human behavior. Through a series of compelling stories and anecdotes, Housel delves into the psychological factors that often derail financial success. Part 1: The Greatest Investors of All Time. Morgan Housel's The Psychology of Money begins by examining the lives and investment strategies of some of the most legendary investors of all time: Warren Buffett, Charlie Munger, and Ray Dalio. While these individuals are renowned for their financial acumen, Housel emphasizes that their success was not solely due to their investment skills. They also possessed a deep understanding of human psychology, which played a crucial role in their decision-making. The importance of luck. Housel challenges the common misconception that success is purely a result of hard work and talent. He argues that luck plays a significant role in financial outcomes. Consider the example of Warren Buffett, who inherited a substantial sum of money from his father. While Buffett's investment skills undoubtedly contributed to his wealth, his initial capital advantage provided a significant head start. The power of compounding. One of the key themes in the psychology of money is the power of compound interest. This concept refers to the phenomenon where interest earned on an investment is reinvested, leading to exponential growth over time. For example, if you invest $1,000 at a 7% annual return, it will grow to over $2,000 in 10 years, even without making any additional contributions. This illustrates the importance of long-term investing and the benefits of patience. The illusion of control. Housel warns against the tendency to believe that we have more control over financial outcomes than we actually do. Investors often fall into the trap of thinking they can accurately predict market movements or avoid losses altogether. However, the reality is that financial markets are inherently unpredictable, and even the most experienced investors can make mistakes. It's important to recognize the limitations of our knowledge and avoid making impulsive decisions based on short-term fluctuations. Part 2: The Psychology of Money. Morgan Housel's The Psychology of Money delves into the often overlooked psychological factors that significantly impact our financial decisions. He explores how these biases can lead to irrational behavior and hinder our ability to achieve long-term financial goals. Fear and greed. Two of the most powerful emotions that drive our financial decisions are fear and greed. Fear can lead us to sell assets during market downturns, locking in losses. Greed, on the other hand, can drive us to chase after high-risk investments, potentially leading to significant financial losses. For example, during the dot-com bubble of the late 1990s, many investors were driven by greed and invested in overvalued tech stocks, only to suffer substantial losses when the bubble burst. Loss aversion. Humans tend to experience the pain of a loss more acutely than the pleasure of a gain. This phenomenon, known as loss aversion, can lead us to hold on to losing investments in the hope that they will eventually recover, rather than selling and realizing the loss. For instance, an investor who bought a stock at $100 and sees it drop to $50 may be reluctant to sell, hoping it will return to its original price. This can lead to further losses if the stock continues to decline. Herding. The tendency to follow the crowd, or herd, can be a powerful influence on our financial decisions. When we see others investing in a particular asset or strategy, we may feel compelled to do the same, even if it doesn't align with our own research or beliefs. This can lead to investing in overvalued assets or following trends that may not be sustainable. For example, during the cryptocurrency boom of 2017, many investors jumped on the bandwagon without fully understanding the risks involved, leading to significant losses when the market crashed. The Endowment Effect. The Endowment Effect refers to the tendency to overvalue things we already own. This can lead us to hold on to assets, even if they are no longer serving our needs or are losing value. For instance, an investor may be reluctant to sell a stock that has been in their portfolio for many years, even if it is underperforming, because they have a sentimental attachment to it. The illusion of knowledge. One of the most dangerous psychological biases is the illusion of knowledge. This refers to the belief that we have a better understanding of the market or the economy than we actually do. This can lead to overconfidence and risky investment decisions. For example, an investor who has had some success in the past may believe they have a golden touch and can consistently outperform the market, leading them to take on excessive risk. Part 3: The greatest mistakes in investing: timing the market. One of the most common mistakes investors make is attempting to time the market. This involves trying to buy and sell assets at the exact right moment to maximize profits. However, Housel argues that it's extremely difficult, if not impossible, to consistently predict market fluctuations. Example: an investor might sell their stocks during a market downturn, fearing further losses. However, if they had held on to their investments, they might have missed out on a subsequent rebound. Chasing returns. Investors often become overly focused on achieving high returns, leading them to take on excessive risk. This can result in significant losses, especially during market downturns. Example: an investor might allocate a large portion of their portfolio to high-risk investments like speculative stocks or cryptocurrencies in the hope of making a quick profit. However, these investments can be highly volatile, and the investor could lose a substantial amount of money. Overconfidence. Overconfidence is another common pitfall for investors. It can lead to a false sense of security and a willingness to take on more risk than is prudent. Example: an investor who has experienced success in the past might believe they have a superior ability to pick winning investments. This overconfidence could lead them to make risky bets that ultimately result in losses. Ignoring taxes. Taxes can have a significant impact on investment returns. Ignoring taxes can lead to lower overall returns and potentially higher tax bills. Example: an investor might sell a winning investment without considering the tax implications. By selling at the wrong time, they could trigger a taxable gain that reduces their overall return. Emotional investing. Making investment decisions based on emotions rather than logic is a common mistake. Fear and greed can lead investors to make irrational decisions that can harm their financial well-being. Example: during a market downturn, an investor might panic and sell their investments at a loss. Conversely, during a market boom, an investor might become overly greedy and invest in overvalued assets. Key takeaways: understand the psychology. To truly master personal finance, it's essential to delve into the psychological underpinnings of our financial decisions. Our emotions, biases, and beliefs can significantly impact our investment choices. Loss aversion. We often fear losses more than we anticipate gains. This can lead to holding on to underperforming investments for too long. Overconfidence. Overestimating our abilities and knowledge can lead to impulsive decisions and poor risk management. Herding. Following the crowd can be risky, as it often leads to buying high and selling low. Embrace uncertainty. Investing is inherently uncertain. Attempting to predict market movements can lead to costly mistakes. Market timing. Trying to buy low and sell high is notoriously difficult and often results in underperformance. Crystal ball illusion. Believing we can accurately forecast future events can lead to overconfidence and risky bets. Be patient. Financial success often requires a long-term perspective. Impulsive decisions driven by short-term gains can erode wealth over time. Compound interest. The power of compounding is a cornerstone of wealth building. Patience allows your investments to grow exponentially over time. Dollar cost averaging. Regularly investing a fixed amount, regardless of market conditions, can help you average down the cost of your investments. Diversify. Diversification is a key risk management strategy. By spreading your investments across different asset classes, you can reduce the impact of any single investment's performance. Asset allocation. Allocating your portfolio among stocks, bonds, cash, and other assets can help balance risk and return. Geographic diversification. Investing in assets from different countries can help mitigate risks associated with specific economies or regions. Avoid emotional investing. Making investment decisions based on fear, greed, or other emotions can lead to suboptimal outcomes. Fear of missing out, FOMO, chasing after the latest hot investment, can lead to overvalued assets and potential losses. Panic selling, selling investments during market downturns can lock in losses and miss out on potential recoveries. By understanding these psychological factors and applying these principles, you can make more informed financial decisions and increase your chances of achieving long-term financial success. If you're looking to master the game of money, the psychology of money is your essential playbook. Housel's insights offer a unique perspective on investing, equipping you with practical strategies to make smart financial choices. Thank you for listening to our compilation series brought to you by Audiobooks Online.